Okay, so we've got a question here which says make the correct trial balance based on the information below. So we've got a trial balance, but some figures are wrongly placed. So we need to put them in their correct place. All right. Yes. So this table here is going to help us. Okay. So we start with the first account. Capital here. Where should it go according to here, this diagram here? Should the amount be on the debit side or on the credit side? Credit side, yes. So we move the amount from here to here, credit side. As you can see, capital, the balance usually is on the credit side, 7,500 here. Okay. These are the double entry rules here. Okay, colleagues? These are the double entry rules. So these are the ones we're following. Okay, the next one is payables. What type of account is payables? Is it an expense? Is it an asset? Is it a liability? Is it income or is it capital? Liability, yes. So according to this diagram here on top, liabilities, the balance has to be on the credit side, right? Yes. So this 8,000, we move it here. Yes. Next, we have receivables. What type of account are receivables? Are they an expense? Are they an asset? Are they liabilities? Are they drawings? Hmm? I can't get you, madam. I'm just asking how do we classify receivables? No, they're not an expense. They're assets. Yes. Receivables, people who owe you money. Okay. Oh, actually, receivable is the money that's owed to you. Then the debtor is the person who owes you money. Okay. Yes. So it's money that's being owed to you is an asset. So we can see assets on the debit side. So this amount is 1,975 comes on the debit side. 1,975. Okay. So I'll be putting the definitions of these things here so that we do not forget. Okay. What about drawings? What is drawings? Debit side. What's the definition of drawings? You're correct to say on the debit side, but what's the definition of drawings? Huh. Colleagues, I hear most of you are accountants in here. Why aren't we shining as accountants, madam? Okay. Drawings is money that you remove for personal use. Money or assets you remove for personal use. Okay. Drawings is a contra capital account. It reduces capital. Capital increases with credit, so drawings increases with debit. Okay. Yes. Any questions? This diagram here should be your Bible for accounts. When you have a Bible for church, that diagram should be your Bible for accounts. Every time you are doing this, we're doing a lesson, have this diagram next to you. Okay. All right. What about return inwards? What is return inwards? What's the definition? Yes, goods returned by customer by a business. Okay. Yes. So now, whenever a customer brings back goods to you, what happens to your sales revenue? Huh? When a good brings when a customer brings back goods to you, what happens to your revenue? Yes, Mr. Kennedy. Yes, the revenue decreases. The revenue, sales revenue decreases. So as we can see on this diagram here, sales revenue increases with credit. So a reduction in sales revenue, you need to debit. So return inwards has to be here on the debit side, 1,200. It reduces uh, sales revenue. Okay, so put here return inwards. I'll put it as RI. Okay, it's a contra revenue. Okay, this is a contra revenue. Whenever you hear contra, it just means it reduces something. What about return outwards? Yes, yes. Let me just put here. So receivable, that's money owed to you. Then the debtor is the person that owes you. Okay. And then payables, money you owe. And then credit is the person that owes that you owe. Okay. Yeah, return outwards, it's when a business returns goods back to its suppliers. So what happens to your purchases expense if you return goods to your supplier? Let's say you sell cement and you've ordered 100 bags of cement at 100,000 kwacha. Then you find 30 bags of cement worth 30,000 kwacha are destroyed. So you return them back to, let's say, suppliers Dangote. So now what will happen to that 100,000 expense you incurred? Is it going to increase or decrease? Madam Agnes, let's say you're selling cement. You've ordered 100 bags at 100,000 kwacha. Meaning, I think each bag should be 10,000 kwacha. Yes. Then you return 30 bags. What is going to happen to that 100,000 kwacha you paid? Mhm. It reduces. It reduces. So, return outwards, also called purchases returns, is a contra expense. Expenses increase with debit, so a contra expense on the credit side because it reduces the expense. Return outwards or purchases returns reduces our purchases expense. So return outwards in this case is in the correct spot on the credit side. Okay. The next one. Yes, I'm recording. Okay. Yes. Carriage inwards. What is carriage inwards? Hey, colleagues, 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 colleagues. Remember, once we enter in this class, yes, the delivery expense you incur whenever you buy raw materials or you're buying your inventory for resale. Okay. In the example of the cement business, when you order those 100 bags of cement, if Dangote tells you to bring the cement to your depot, it's going to cost you 200 kwacha. That's carriage inwards. So it's an expense. Okay. It is an expense. So it means, according to our diagram here, expenses debit side. So carriage inwards is an expense. What about carriage outwards? Mm-hmm. Yes. Yes, can someone raise their hand? You can go ahead. That's correct. Yes, if you transport goods to your customer and you're taking on that transportation charge, that's return as carriage outwards. Okay, so it's also an expense. So carriage outwards, yes. So expenses on the debit side. So here, purchases. What is purchases? Yes, colleagues, purchases. This should be the easiest one. Yes, goods bought by a business for resale. So it's an expense, right? So we have to so expense here. So I'm highlighting what type of account each of these things are. So that when you reach the topic of financial statements and you see these things, you know what they are. You shouldn't be asking yourself, what is this? What is this? Closing inventory. Yes. Mhm. Yes, the goods you remain with at the end of the period. Okay, so if back to the cement example, okay, if on 31st December you remain with 50 bags of cement, that's your closing inventory. Then on 1st January, what does that closing inventory convert into? Those 50 bags of cement you had on 31st December, on 1st January, what are we going to refer them as now? Yes, that's correct. Yes. Opening inventory. Yes, but yes. Eh, is someone raising a, has someone got a question? Okay, discount allowed. This is when you give your customers a discount. Okay, so now, colleagues, okay, if you sell one bag of cement to your customer at a discount, it means you're getting less money, right? Is that is that accurate, colleagues? Mr. Emmanuel, is that accurate? If you sell a good or any item to somebody at a discount, it means they're receiving less money, right? Yes. So if you give the customer, let's say, a 200 kwacha discount, it means you're losing a 200 kwacha. You're getting the money that you're getting is less by 200 kwacha. So that 200 kwacha is your discount allowed. Now, according to your business, since you have lost that money, you treat it like an expense. Okay? Discount allowed is treated like an expense since you've lost that 200 kwacha. Okay? So a loss is treated like an expense. So discount allowed, according to our diagram here, expenses debit side. So the amount should be here. So it's a loss which is treated like an expense. What about discount received? Yes. Thank you for your try. Okay, so there, what you have described there is what you call a trade discount. Okay, a discount where when someone buys in bulk, you give them a discount. That's a trade discount. Yes, but that will fall under discount allowed. Okay, sir, that will fall under discount allowed. You've got two types of discounts. You've got a cash discount and a trade discount. Both of these can be either discount allowed or they can be discount received, depending on the context of the equation. Okay. A cash discount is a discount that you give so that someone can pay you fast. Okay. Cash discount for fast payments. Okay. So even you as a business, if you give your customers a cash discount, that will be discount allowed. Then a trade discount is when you're getting discount in when you buy in bulk. That can also be a discount allowed. Now, discount received, this is when your supplier is giving you a discount. Okay. So when your supplier gives you a discount, it means you're saving some money, right? Let's say the cement when you buy at Dangote, okay, maybe let's say they say, okay, you've been a good customer, we're giving you a 30% discount. It means what you're paying is going to be 30% less, right? So that 30%, which it's like a saving to you. You have saved some money. So any savings are treated also like income. Okay, so discount received be treated like income. Okay, you have saved some money. And then, according to our double entry rules, income is on the credit side. Okay, so this amount 50 has to be there. Okay, so your supplier can also give you a cash discount. Maybe if you buy on credit for them, then they want you to pay them quick. Okay, because cash discounts is usually, especially when for credit sales, people are owing you money, so you need to collect the money as fast as you can. So you try to give them a cash discount so that you can collect your money fast. Okay, so your supplier can give you the cash discount if you're getting on credit from him, so that you pay him faster and you save some money. Or they can give you a trade discount if you're buying in bulk. They'll give you a trade discount. Okay, and you save some money because you're paying less. So that will be treated as income. Commission received. As the name says. Oh, yes, Madam Agnes. Just a commission earned by business. Mr. Kennedy? But, mm, you are the agent in this case and you've got that reward. Okay. Yeah, you are the agent of another business. Your business is an agent for another business and you've got commission. So in accounts, anytime you hear the word received, okay, just know that is income. Commission received, discount received, rent received, dividends received, interest received. Just know that, okay, that I'm dealing with income there. Then sometimes this income may not be given to you yet. So it can be called commission receivable. Okay. When the income hasn't been given to you, then they will add now the receivable word there. Okay, it means you're being owed some money. Okay, you've done a commission for someone, you've done something for someone, and they're owing you a commission. So if you see commission receivable, that is also income. That's just income that hasn't been paid yet. Okay, so this is according to the accruals concept of accounts. Right? When you incur an expense or when you earn income, revenue, you record. That's the accruals concept. Okay. Regardless if money hasn't passed exchanged hands, you still record the transaction. Okay. So if you see commission receivable, that's what we call accrued income. That is money being owed to you. Okay. Yes. So income, revenue, credit side. Okay, wages and salaries, self-explanatory. This is an expense. Expenses, debit side. So we're on the correct place. All right. Here next we have sales revenue. Sales revenue. Remember, colleagues, these when I ask what is this, just follow what the word has said. Okay. So only certain things maybe it's not what the word is actually implying. But sales revenue, what is it, colleagues? You're selling cement and you sell 70 bags. What will you call that? What would we call that? Mr. Peter, you're selling cement and you sell 70 bags. What will refer that to? Yes, sales revenue, yes. So revenue and income, credit side. So here we have to move this 8,000, or not debit side, credit side. So we have to move this 8,000 to the credit side. Cash, this is the money you have on hand at the business. Is cash an asset, a liability? Is it income or is it revenue? Yes, but after it becomes an income and it stays in your pocket, what is it referred to now? It's an asset, yes. Yes, this cash comes from income that you receive and revenue that you make. But now, once it's in your business, it's an asset to you now. So, asset, the amount has to be on the debit side. This 10,000 is in the correct place. Bank, same thing, it's another asset. Amount has to be on the debit side. Motor vehicles, this is another asset. Now remember, assets, they are current and non-current assets. Okay, what is the difference? Please do. Yes. Let's remove that long-term source. Okay, not necessarily, because assets, yes, they can help you generate income, but other assets might not help you generate income. That's a current asset. That's an asset that has to be used up within 1 year. Then a non-current asset, you can own it for more than 1 year. Okay. Current assets usually you can't own them for more than a year. They'll be used up as the year goes up. Okay, they'll be used up. Okay, but non-current assets you can own them for more than you can own them for as long as you want. Okay, so it's just the timeline of a year which separates the two. Okay, bad debts. Anyone who works for Zamcash here? Or anyone who has ever done microfinance business? You must be well aware of this term. And yeah, okay, but basically, if you bad debts, this is money that you don't recover. Okay, if people are owing you money and they don't pay, that's what we call bad debts. Okay, this is money that you've lost out. Okay, you borrow someone money, they don't pay you back. You sell goods on credit to a customer, they don't pay you back. Okay, so bad debts is an expense because you've lost out, you've lost money. So it's an expense. Okay. Sometimes you see it's written as debts written off. Yes. Same thing. When you write off a debt, it means let's wait. Writing off a debt means you're not going to get that money back. So you're forgetting about it basic. That's bad debts basic. Okay. But there's another one which is called provision for bad debts or provision for doubtful debts. Okay. That one, it's an estimation. Okay, it's an estimation. You're saying we might not get this amount this year. Okay, because as a business, you'll be doing credit sales. Now, not all of those customers are going to pay you. Okay, so that's why you make a provision for doubtful debts. Okay, Provision for doubtful debts is a contra asset. It reduces the receivables amount. Okay, reduces the receivables amount, but it's more like an estimation that you're estimating how much you might not get. Okay, sometimes you might get everything. Other times, your estimation might be less. But as a business, since you are aware that it's not always people pay you, you always have to make a provision for bad debts or provision for doubtful debts or allowance for doubtful debts. Okay, you'll come across this term. So just remember, bad debts when you know that you're certain the money is not coming back. Provision for doubtful debts, yeah, anticipating. Okay, you are anticipating. And provision for doubtful debts contra asset, meaning if it was here, it would have been on the credit side. Overdraft, this is a liability. So which side is it supposed to be on? Is it on the correct side or on the wrong side? Credit side, yes. According to this, liability is credit side. Long-term loan or overdraft is a current liability. What's the difference between a current liability and a non-current liability? Mhm. Yes, that need this is debt that needs to be paid within 1 year. Okay, so even an overdraft, if you get an overdraft, you're going to need to pay it that same year. They'll never allow you to go over a year. Okay? Yes. So long-term loan, this is a non-current liability. Okay, this you have to pay it. You can pay it after a year even. Okay, no need to pay it that year. So it's going to go on the credit side. Yes. And finally, fixtures and fittings. Mm-hmm. Yes. More fixture and fitting asset, yes. Not current asset. And so once you have put everything where it needs to be, you need to just total up the total debit side, total credit side. Yes, debit and credit need to be the same amount.